Hi, I'm Garrett Nelson, Vice President of Equity Research at CFRA. I'm the research analyst who covers Tesla here and wanted to put together this short video to examine the investment case for owning Tesla shares. We're calling this video Tesla, Looking Past the Noise, because let's face it, everyone knows who Elon Musk is and probably everyone has an opinion about him and this company one way or another. Hardly a day goes by where he isn't making headlines of some type. He's brash, outspoken, irreverent, and he's also one of the wealthiest people in the world. But in order to make a rational investment decision about Tesla, we think one really needs to look past all the noise surrounding Musk and the company and really focus on the fundamentals and long-term opportunity. So in this video, we examine the investment case and also addressed some of the most common talking points that the bears bring up to support their bearish recommendation, and also why we think those talking points are flawed. And moving on to the next slide. So we have a strong buy and $415 price target on Tesla. Early this summer, on June 21st, we published a thematic report entitled Tesla, Recent Sell-Off Creates Generational Investment Opportunity. We argued that with the stock down about 40% year to date at that time, it presented a compelling entry point, and we explored the company's long-term growth potential. One of the things we said in the report is we view Tesla as a company with the potential for industry disruption, market share gains, and long-term equity performance similar to companies like Apple and Amazon several years ago. But earlier this year, the stock price suffered from a broad technology sell-off, growing recessionary fears, COVID-19 related issues at its Shanghai factory. Elon Musk planned stock sales to fund his acquisition of Twitter, and also concerns related to top line and earnings growth from both growing competition and rising costs. But in our view, these factors were really overshadowed several key positives in the story. The company's had exceptional operational and earnings execution over the last several quarters. They just started production at two brand new factories, one in Austin, Texas, the other in Berlin, Germany, and their earnings are poised to grow dramatically as they ramp up production at those two factories. They've also had dramatic balance sheet improvement over the last few years to the point where they're sitting on a huge amount of net cash. And we also feel like they have an impressive pipeline of future products. And over time, you're going to see much more revenue and product diversification from the company. Since then, Tesla stock has rebounded sharply due to a broader stock market bounce. This is a relatively high beta name. Tesla has a beta of about 2.2. They announced a 3-for-1 stock split, which they just completed a couple weeks ago, and the stock had run up heading into that the split. They also posted a much stronger than expected second quarter and had strong guidance for the balance of the year. And then there have also been some positive developments related to advances in their full self-driving technology, and also the timing of the semi-truck, which Elon Musk is now saying could come by the end of this year. So here we examine the investment case for Tesla. Here on this slide shows the company's exceptional earnings execution over the past 12 quarters. In fact, their revenue and earnings have only fallen short of consensus once in the past 12 quarters. It's a very strong track record. And this was not the Tesla of before this period in 2019, when they would miss one quarter, they'd beat the next, and they weren't consistently profitable until fairly recently. So, and that's why they were qualified for S&P 500 inclusion, which happened in late 2020. But in our view, the second quarter results that they posted in late July, it was perhaps the company's most impressive quarter in their history, considering the headwinds that they were dealing with, the shutdown of their large factory in Shanghai due to COVID issues, ongoing chip shortages, and supply chain issues. all of these things, and they still posted, despite revenue, which was about in line with consensus, the bottom line beat was very significant, as you can see here. So here's a slide showing Tesla's installed annual vehicle production capacity, and what they've really done with the startup of the two new factories in Texas and Berlin is, those factories are now running, as of their second quarter earnings release, at a capacity of over 250,000 vehicles a year. But they're still ramping up to full capacity, and we think with the addition of these two new factories, Tesla has essentially doubled their production capacity, and that's a big part of the earnings growth that's going to drive the stock over the coming quarters, going to drive bottom line results. On this next slide, so this shows Tesla's actual cash flow from operations, CapEx, and free cash flow over the last 6 years, and also the consensus outlook, consensus forecast for these three line items going out to 2030. And as you can see, in consensus is baked in a company that generated a little over $5 billion of free cash flow last year. Their annual free cash flow is poised to grow to north of $50 billion by the end of this decade. So it's very impressive free cash flow ramp that's coming. And the company's goal is to grow their annual volumes back by a factor of 40 between the 500,000 vehicles that they sold in 2020. They want to grow that to 20 million units by 2030, which would make them the world's largest auto manufacturer. So looking on this next slide, here's a snapshot of Tesla's quarter end net debt. They've gone from about $5 billion of net debt at the end of 2018 to $19 billion of net cash. So $24 billion swing. So they have a very strong balance sheet now. This was not always the case with Tesla, and their cash could continue to grow as we expect them to throw off a significant amount of free cash flow over the next several quarters. This slide shows estimated U.S. electric vehicle sales volumes by brand in the first half of this year, and this is from Kelley Blue Book and Cox Automotive. But what it shows is that in the first half of this year, Tesla accounted for over 70% of all battery electric vehicle sales in the U.S. The next closest company was Ford, but Tesla had more than 10 times the amount of battery EV sales as Ford. And you can see the growth. Their U.S. sales are up 79%. We're up 79% in the first half of this year. And also, what a lot of the traditional automakers are doing, they're really betting more on plug-in hybrids than pure battery electric vehicles. You can see companies like Toyota is second behind Tesla, but essentially all of their EV sales so far this year have been plug-in hybrids. So Tesla really has a dominant position in EVs. So next we look at some of the bear case arguments, right? They're the bulls and the bears in this stock, and but one of the things we hear most often from those who are bearish on the stock is it is just dramatically overvalued. How can you have a buy on the stock? But if you look back, if you look at the absolute valuation over the last 5 years, Tesla has traded at a forward PE multiple of 139 times. Over the last 10 years, its forward PE has been 164 times. So currently, the stock is sitting here trading well below those multiples. It's trading at only 46 times the consensus estimate for next year. And if you look out to 2024, the stock's trading at only 39 times. So a fraction of these historic multiples where it's traded over the last 5 or 10 years. But if you look at the rest of the industry, companies like Ford and GM, over the last 5 to 10 years, those stocks have, on average, have traded anywhere between 8 and 9 times PE multiple, Ford PE multiple. But we think Tesla's massive premiums are justified relative to these other automakers and the rest of the industry, because we think the company is a lot more than just an auto manufacturer, and it's a very high margin auto manufacturer at that. But it's a 21st century sustainable transportation and energy provider. But if you go and you apply these historic multiples, say, okay, let's assume it trades at 139 times 2023 earnings, what does that imply for equity valuation? It implies a stock price of over $800 versus the below $300 where the stock is currently trading. And if you apply the multiple, the 164 times multiple at which it's traded over the last 10 years, you get a stock price of over $950. So we don't think it is dramatically overvalued at all. In fact, we think it's undervalued. So this slide looks at the company's actual revenue and earnings and vehicle sales since 2015, and then forecasts going forward for these different items. And you can see that we're expecting earnings to more than triple between 2021 and 2024. They earned $2.26 last year, split adjusted, and we're expecting that earnings number to grow to $6.90 in 2024. So more than a tripling. The key point about this is, it's being driven by the ramp up of the 2 new factories, and there's really no other company in the consumer discretionary sector that has this kind of earnings growth expectation. And in going beyond consumer discretionary, there's probably very few to no companies that have this kind of earnings growth trajectory over the next few years. So if you're a believer that earnings growth drives equity values over the long term, we think this is a very strong case for why the stock is a strong buy in our opinion at these levels. And then, if you look out to the end of this decade, considering the earnings growth, the shares aren't so expensive. If you assume that the company continues to execute and grow their earnings over the long term, along with this explosive production growth that they are expecting in their long-term plans. In fact, looking out to late this decade, the stock's trading at a PE multiple at the current price of only between 25 and 30 times earnings. So the other common bear argument is that competitors will eventually overtake Tesla in EVs, but our counterpoint to that is really other EV models haven't sold particularly well at all. We've seen this from many other traditional automakers who have tried to get into EVs over the last several years. Many of those models have been discontinued due to poor sales. The product just didn't catch on with consumer, whether it would be the battery range wasn't adequate, it was priced too high, you name it. But there's been a lot of issues and a lot of reasons why Tesla EVs have caught on with consumers, but other EV models from competitors haven't. The Model 3 and the Model Y are the best-selling battery EVs in the U.S. by a wide margin. Sales volumes of each in the first half of this year have been more than 5 times the number 3 best-selling EV, which was the Ford Mustang Mach-E. And also many other automakers, while they've come out with a lot of hybrid models, there haven't really been a lot of pure battery EV models, and they certainly haven't mastered the art of mass production of EVs. They've mastered the art of mass production of internal combustion engine vehicles, of course, but producing battery EVs is a whole different ballgame. And we would remind everyone that Tesla, for several years, from roughly the start of the company until 2017, 2018, we're in a period of what Elon Musk has famously called production hell. They hadn't mastered the mass production of EVs just yet, and it's really just in the last few years they've really turned the corner with these massive new factories in China, Texas, and Berlin, where they've really mastered the art. And so we think there's a lot of growing pains that both traditional automakers who are just now getting into EVs have ahead, but also some of the newer upstart electric vehicle manufacturers. And you're seeing that, from the results of companies like Lucid and Rivian and others. We also think the new Inflation Reduction Act just signed into law was a huge windfall for Tesla. With the signing of that law, 70% of the 72 EV models that are currently for sale in the US became immediately ineligible for the $7,500 federal EV tax credit. Meanwhile, most versions of the Model Y and the lower price version of the Model 3, as well as the forthcoming Cybertruck, should qualify for a $7,500 tax credit beginning on January 1st of 2023. And that's a big deal because Tesla had previously phased out of the tax credit program, having hit the per manufacturer cap. And so all of a sudden, these two best-selling EV models are going to be eligible for tax credits starting January 1st. So that's going to be a huge near-term tailwind for Tesla. And the final slide is that we also think Tesla is not being given enough credit for recent advances in autonomous driving. In our view, they are leading the race in this autonomous driving race, similar to the space race back in the 60s. There's this race to create a fully autonomous vehicle that's happening right now. Who's going to get there first? Tesla has really taken a different approach compared to many other automakers, relying heavily on cameras and radar and really shunning LiDAR technology. And so we think that, when you look at the recent updates of their full self-driving software, it's improved dramatically over the last year or two. And for that reason, they recently increased the price of their full self-driving subscription in North America from $12,000 to $15,000, just went into effect. And this is really critical because software sales carry much higher margins than vehicle manufacturing. And so it should have a big bottom line impact and is a big tailwind for Tesla. And then the final point that we would make is Tesla's size itself is a major strategic advantage because it can fund growth much more inexpensively than competitors. You look at the company today, Tesla's market cap is more than 4 times that of Toyota, which is the world's largest auto manufacturer in terms of annual sales. They sell almost 10 million vehicles a year. That's despite the fact that Tesla's sales are only about 1/10 of what Toyota sells. And so, the point we're making with this cost of capital advantage is that if Tesla were to do a fairly modest equity offering today, increasing their share count by say 1.5%, they could raise almost $13 billion gross if they were to do such an offering with very modest dilution to shareholders. And that amount would be more than the company spent in CapEx collectively in both 2020 and 2021, which were years in which they invested very heavily to build the Texas factory and the Germany factory. And so, we're not necessarily saying that we think they're going to do an equity offering, although they strategically have done equity offerings in the past. They can fund their growth through operating cash flow, we think, but it's a very significant advantage that they have in terms of their cost of capital, just because of the size of the company itself. And we do think Tesla will be announcing that they're moving forward with 1 or 2 new factories fairly soon, probably in Canada, possibly in India and elsewhere. We think there'll probably be an announcement in the next few months regarding that. So I hope you enjoyed the video. These are just our high-level thoughts on Tesla. For more information on our research, that thematic report I referenced that we published out back in June, you can visit us you can find that on MarketScope Advisor, along with reports on all the other automakers that I mentioned today. Thanks very much and have a good day.